Hey traders and investors, it's Serge Berger here once again from my stand-up paddleboard. It is summer after all. Look at that beautiful scenery I've got going on again this morning. I just made a special video for my Clubhouse members, but I also wanted to be fair and kind of share some of my thoughts here coming into this coming week with the broader audience. So there's a couple things to look forward to. For one, of course, next week we have earnings season kickoff. We've got Alcoa, and we have, more importantly, some of the banks come out. That's number one, of course. On the other hand, last week after that jobs report, which came in much above expectations, although the May jobs report just a month ago came in well below expectations. That's a huge divergence. Not quite sure if that's actually ever taken place, which all of it makes it quite curious. So the S&P is about to break out. At the same time on Friday, we saw very curious price action. What we saw is stocks rally, commodities rally, and bonds rally. Something is probably off here. I suspect equities are overextended. I'm not calling for a crash, but I suspect they're overextended. So I want to show you guys a couple things in the chart. We're going to keep this very neat and clean coming into this new week here with earnings kicking off. I want to be a buyer of some volatility. In other words, I'd like to be a buyer of some debit spreads, maybe some put spreads, making some quasi-bearish bets in some of the banking stocks, considering volatility being low. And again, I think the broader stock market is at least near-term somewhat overextended. So let's move on over to the charts. Okay, so let's look at the charts real quick. There's really two things that I want to go through here as we prepare for the coming week. Number one is the S&P 500. Number two is volatility and banking stocks. So let's look at the S&P 500 first. And also, as I told Clubhouse members in a special video that I just made for them over the weekend, is we can draw breakout lines, more or less at our discretion. If you draw it like this, we have not yet seen a breakout in the S&P 500. If you are a little bit more tedious and you sort of, or say more creative for lack of a better term, and you might draw these lines a little bit more like this or even like this, we arguably have seen a breakout. To me, the point is very simple. We've seen a fairly aggressive move over the past few days in the S&P 500. Yes, there could be some more upside, but coming into earnings seasons, I think we have to be somewhat cautious. We could see a further move higher, yes, but the reality is we probably will see corporate top and bottom line slowing once again year over year, maybe improved quarter over quarter, but down year over year. And arguably, that's a very difficult time to chase stocks higher. So for me, I remain cautious in the S&P 500. More importantly, I think being long or short the S&P 500 in 2016 and in 2015 has been one of the very hardest trades. There have been many easier trades to do away from the S&P, whether that's single sector, single name stocks, or entirely different themes like gold and silver. So that's number one. I think the S&P is somewhat overextended. I wouldn't chase it. In fact, I'm more or less staying away from it from a bigger picture perspective. Number two, banking stocks. We look at something like a Bank of America, and I've highlighted this in this public vlog time after time over the past, let's say, 20 months or so, and you can see we continue to be at a very precarious technical spot. Once we rallied off those oversold lows in February, came into those highs here in April and May, we rejected what used to be support around $14, $15 or so. We now reject it lower. Two things are keeping these banking stocks basically capped as far as I'm concerned. One is the economic growth story. There isn't much of an economic growth story, number one. And number two, interest rates. Interest rates continue to move lower, and that very simply is not exactly helping the yield curve steepen. And so I think it's very difficult for these banking stocks to start moving higher. In fact, I think they'll be lower before they are higher. So for me, I'm a marginal seller, short seller, and maybe using options in some of these banking stocks over the next week or two as we see bank earnings come out. And last but not least, as far as implied volatility goes, look at something like the VIX, which gives us a popular measurement of implied volatility as far as the S&P 500 goes at least. And you can see the VIX is once again sub 14, where I think reward to risk for a trade on buying some VIX calls, let's look at 1 to 2 months at least, using options 1 to 2 months out, is, I think, a pretty good call to see the VIX at least mean revert back into the 17, 18 area or so. So that's what I'm looking at here coming into the week ahead here. It's always important to be prepared and also study over the weekend so that we plan our moves ahead of time and not have to make decisions on the spot.